In tonight's online tutorial, we've got a few things planned for you this evening. So we are focusing on the consolidated SSP. And in particular, I've got a couple of things that we're going to look at tonight. We're going to do one big question, and we're going to do this from start to end. So a big question from start to end. And we're going to have a look at our non-controlling interest in a bit more detail, because of course we have a choice of accounting treatment. Show you the difference between the fair value method and the proportionate method. And finally, I'm going to look at the impact of impairments on goodwill. And be impacted by which method of NCI valuation was used. Let's start with tonight's first big question. We've got some exam technique in your online tutorial workbook. You should have a copy of this workbook that I've got through on screen in front of you as you work through this online tutorial. And on the first page of it, you will find the exam technique. The first thing that you're going to do in your exam is read your requirements, and let's add to that, you will calculate your timing, and your timing, unless you get extra time, will be based on 1.8 minutes per mark. Okay, always calculate your timings, and we do need to be very strict in the FAR exam with our timings because it is quite time pressured. Next, you're going to lay out your pro forma, and by that we mean your template blank consolidated SSP. There will be presentation marks available, so make sure you set it up in a format suitable for publication. It's a template that you should have learnt by heart by the time you go into your exam. You do set this up front as well, because we're going to try and populate it as we go along. So let's just say here we will populate as we work through the question. And they're also going to set up our standard workings. So at least standard workings 1 to 5. We may need more than that. So sometimes it's worthwhile doing your working 1 before setting up your pro forma, because that will determine if you've got any associates, in which case, of course, you'll need a line in your SSP for investment in associates, and you'll also need standard working 7. I'm going to try and prioritise that easiest mark first. So always start with the easiest numbers first. So for the easiest mark, half mark you'll only get for it on the paper, will be for putting in just the parent share capital and share premium, and then you can put into open brackets 100% of P and S's added up liabilities, assets and liabilities, sorry. And now please bear in mind, this is the exam technique for creating a consolidated SSP from individual SSPs. If you've even a draft set of consolidated financial statements, you won't be able to do this part B here. So try and spot any numbers that would go into your working 2. Working 2 is the net assets of the subsidiary. So you're looking for things like the subsidiary share capital, the subsidiary's retained earnings at the various different points in time. We want to go through our additional information, and we're going to try and spot some adjustments. Again, very important, it's all about priorities in the exam. We want the easiest marks first, so we may jump around the adjustments out of order. Make sure when you're working through the adjustments, you show any workings that you've used. These need to be referenced. Okay? The examiner gets very frustrated if she gets in loads of workings, but she can't work out what they relate to. So please do reference your workings. Obviously, you've already used your standard workings 1-5. By the time you get to all the adjustments in a question, you might be at working 11. Doesn't matter what numbers you're using, as long as it's nice and clearly referenced. You've processed all of the adjustments, or at least as many as you've got time for. What you then need to do is at the end leave enough time to complete your working 2, and from that, workings 3, 4 and 5 will flow. And I'll show you what I mean by that in a question, which will enable you to get lots more easy marks. It's just a case of tidying up, so adding up all the numbers on your back sheet to get all your presentation marks available. have this in front of you as you work through the question, because that's the approach that I'm going to take, and we're going to use this question over the page, DIL. DIL is a nice, simple question. It's possibly on the slightly, and I mean ever so slightly, not quite exam standard, but it's 95% exam standard, but we have picked a sort of nice exam question. So this is an old question. It's not in the question bank, so it's extra practice for you. When DIL's got an investment into two companies, Rosemary and Basil, and we've got a year end of the 31st of March 2011. My first tip for you is to make a note somewhere on the top of your page in a big red pen or something of year end, because that's going to be really important. If anything needs prorating at all, you have it as a reference point, and you do need to be very careful because it's unlikely that every exam will have a December year end. We've got underneath then the two SFPs for Basil, Rosemary and DIL. So remember then, we know that DIL is the parent. At some point we will need to work out what percentage of Rosemary and Basil we own, but you can see that these are fairly standard looking SFPs. We've got their non-current assets and assets through to their equity and liabilities. We've also got some additional information, so let's have a look how much of it we've got. We've got 7 bits of additional information, and finally we've our requirement. And our requirement was one of the first things that we wanted to look out for, compare the consolidated SFP of DIL as at the 31st of March 2011. Conveniently for us on tonight, we have a template pro forma already drawn out for us. If you remember, one of the first things that we should do is to set this up. So fortunately for us, just to save you watching me writing it out, we've got our consolidated SFP all set up. Okay. In terms of lines that we've got, you can see we've got a line there for the investment in the associates. I've a line for intangibles. I'm actually just going to change that, if you don't mind, to will. And what I am going to do is just add in all my references. So my goodwill is working 3, investment in associate is working 7, inventories, receivables and cash, don't need those yet. Here, apart from my retained earnings, I'm going to reference working 5, revaluation surplus working 6. If I need it, I might not actually need that one. And there is my non-controlling interest. There is that working 4. So the first thing that we said we were going to do was to try and get our easy marks. I do need to set up my standard workings. So let's start with working 1. You may have done this before you set up your pro forma. I know I've got DIL, Rosemary, and I determine whether I've got subsidiaries or associates. So I need to look at the share holding that we have in each of these companies. So come back, very often this will be number 1 in the additional information, and we're told that DIL acquired 400,000 shares in Rosemary, so that's going to be DIL shareholding. Let's look at how many shares there are in Rosemary in issue. So have a look at Rosemary's column and their share capital. There's 500,000 shares in issue. So we bought 400 of the 5,000 shares in Rosemary. That's 80%. Do the same to DIL while I'm on screen. So DIL has got total share capital of 400,000. Let's see how many of them we bought into, and it is normally the first sentence. We bought 160,000 shares. So come back down to my workings. I've got 400,000 of 500,000 shares, which is 80%. 160,000 of 400 shares in Basil, which is 40%. Therefore, I can determine, can't I, that Rosemary is a subsidiary and Basil is an associate. I want to set up my other standard workings, and I'm actually going to do these in a separate screen so when I flick I don't have to scroll so much. Let's have a think first about working 2. or some fancy calligraphy pen, I think. Let's go for just a normal pen. So my working to is my net assets of subsidiary, and here my subsidiary is Rosemary. Make sure that you jot down enough information that you don't get confused, and all we want to worry about with working to is everything to do with the net assets, which were equal to the equity of the subsidiary. I'm going to consider it at two different points in time, at the year end, so balance sheet date, and at acquisition date, and then finally I want to think about the movement between them. And I try and populate as much as I can. I'm going to populate my share capital, any revaluation reserve, any retained earnings, and any adjustments. I'm going to make all my adjustments to retained earnings, so I then leave a nice bit of space, because who knows how many adjustments there will be. If you have a read of point number 1 in the additional information, you'll find that we can fill in quite a few of these numbers. Just do it while I'm on it, and then I'll go and set up the other workings. But while we've got it on screen, it's quite nice. It tells us that we acquired 400,000 shares in Rosemary when the retained earnings of Rosemary were £217,600. I already know, don't I, that Rosemary share capital is 500,000, and that will never change between acquisition and the reporting date. Rose does have a revaluation reserve, certainly at the year end of 150,000. I can't spot anything for here yet, so I'm just going to leave it blank and come back to it. However, from the year end balance sheet, I can also see that Rosemary has got 356,900 of retained earnings. I just need to nap up a bit. Like I say, I'm going to leave plenty of room in case there are, of course, any adjustments. Let's set up my working 3. Working 3 is for goodwill, and once again I'm only thinking about Rosemary here. We don't have goodwill in associates, so I'm not going to bother with it for Dill, of course. So to calculate my goodwill, this is again a working that you should be familiar with. We're going to do our consideration and non-controlling interest, 100% of Rosemary's net assets at acquisition, maybe less any impairments. That will get me to my goodwill at the acquisition date, but I also need to take away any impairments to my goodwill at the year end. That number there that I'm hoping to put on my balance sheet later on. You've spotted some easy numbers for here. We'll have a read through properly in a minute and see if I can populate anything. What would be useful at this point in time, though, is to look for what method of calculating our NCI we are using. So let's see if we can spot it if I go back to the question. So zooming back up here. Generally speaking, it will tell you fairly early on, but we'll have a scan read through this question. I can just about spot it. It's not too on in this one, but it does tell me here, choosing to value its NCI using the proportionate method. Okay, that's great. That tells me in here I'm going to be using the proportionate method. So when I set up my working 4, I can set it up using proportionate method. So what 4 is my non-controlling interest. All I need to do there is NCI share times by the subsidiary. So here Rosemary's net assets at reporting date. And if you want, you can almost this. If I 80% Rosemary, the other people must own 20%. So I can set that up straight away. On my working 5 is my group retained earnings. And this is a working that you will need to have learnt, but I'm going to start by taking 100% of the parent's retained earnings, year end, add on the parent share of the subsidiaries and the associates post-acquisition retained earnings. Then I have some adjustments like perps, maybe impairments that I need to think about. Also here is that I'm going to have to think about both rosemary and dill. So I'll forget for rosemary and another for dill. I'm going to leave that working open because I'm not quite sure what's going to go in there just yet. Now, I may need a working 6 for my group revaluation reserve, so I'm not going to set it up because you don't always need that working, but leave some space for it or I'll come back to it later. I do, however, know that I'll need a working 7 for my investment in the associate. Here, if I'm talking about my investment in the associate, this, and I've been saying Dill a few times, and I apologise. Dill's parent company, it's Bill that's my associate. I'm ever so sorry. So we'll change this here quickly to Basil. Very herby, this question, isn't it? What I'm looking for my investment in associates? Well, it's simply the cost of the investment, and then you want to add on the parent share of the associates acquisition profits or post-acquisition net assets. Then in impairment, there might be another adjustment, so leave plenty of space. You definitely want to spend some time up front setting up your standard workings. What's nice is on my pro forma SFP, I've already referenced lots of these, haven't I? So you set your references up beforehand using your standard workings. It means that you don't have to worry about it later on. That we said we were going to do, then we were going to try and get as many easy marks as we possibly could at the start of the question. So one thing we said we wanted to do was to add up all of the parent and the subsidiaries assets and liabilities. So let's do that, and that one I don't need to do separate workings for. I'm simply going to work directly on the pro forma itself. Thinking about PP&E, I want to add across all of the individual lines for the parent and the subsidiary. I don't want to bring my associate Basil in here because instead I'm going to just show this one line for Basil, but I certainly need to consolidate everything to do with rosemary and dill. PP&E, let's show you an example one. I go back up to my financial statements. I want to add across, don't I, the 50,900 PP&E for dill and 917,300 for rosemary. I want to bring these two investments in because instead I'm either consolidating or showing the investment in the associates. However, I will need that £250,000 in working 7 as my cost of Basil. Let's just bring these numbers in, and bear in mind I'm going to be doing this for all of these numbers here as well. Just adding them across in the brackets. Here we go. So I've got 500,900 plus 917,300. It's going to get squished for me, I'm afraid. So hopefully if you've left plenty of space, which is what you should do in the exam, it will be easier. And I can probably make my life slightly easier by zooming in a bit. Let's see if this works. A little bit better. My inventories then, I've got 345,600. I'm going to go over 2 lines so that I don't run out of space. 245,900. And what the examiner wants you to do is write the numbers. Don't write P plus S. Actually write the numbers out. You don't need to label which one they're from. The examiner can work that out. So 179,800. You should be leaving these brackets open in case we need to add anything to them later on. Cash and cash equivalents, 1,500 plus 700. In terms of my ordinary share capital, I just want the bit attributable to Dill, so I'm going to pop that on straight in from Dill's balance sheet, £100,000. I might need a workings for, so I'll keep going over those. I get to my trade and other payables, so I can add these ones up again. 166,000 for dill and 256,800 for rosemary. And my tax, I've got 120,000 for dill and 80,000 for rosemary. Okay, there's lots of easy marks going. Think about other easy marks that you can fill in. on the wrong screen again. So other easy marks, we've got the one for the net assets of the subsidiary. We also spotted in working 7 the cost of the investment in the associate. Well, that was simply the £250,000 still paid for its investment in Basel. So I'm going to pop that 250,000 in. In green, sorry, I'll colour coordinate it. If it's in green, it's an easy mark. We also, in our working 5, populate our parents' share, or just our parents' retained earnings. So the girls' retained earnings are 767,500. We've got two of easy marks there, but can you see we could have only got them by having all of these working set up? So it is very important that you do that. Now, what we next need to do is start working through our additional information. Now, it is a bit of personal preference on how you start working through things, but you know, it takes a bit of practice. You just have to start spotting the easy marks in the question. So let's go to the additional information and let's have a look at points 1 and 2. Quite often they're just telling you a bit about the investments that you own. There might be some easy marks here. I can spot one straight away. The consideration paid for Rosemary was £600,000 paid in cash, 200,000 shares in Dill to be issued on the 1st of April 2011. Well, this is my year end. We're producing these financial statements the day before that, so it's the day before my year end. Value these shares then? Well, I want to think about what market value is relevant, and here they're giving me 2 market values. I'm going to have to be careful. So they're telling me at the date of acquisition the market value of each share was £1.40, but it has risen to £1.60 by the year end. You've got to know that you want the market value at acquisition, because it's how we define the fair value. The market value at the year end is a lie. It's a red herring, and it's something that the examiner does a fair bit to see if she can catch you out. So do vary those. 200,000 shares at £1.40 and £600,000 cash. So I can fill these straight into my consideration line, can't I? I've got the cash with 600,000. Oh, I'm getting away here. I'm adding an extra 0, and I've also got the shares. And the shares, I've got 200,000 of them, and I'm going to show the examiner that I have selected the £2.40 price. Saying £2.40, which is because it's £1.40. Let's see if I can work that out. That's £280,000. So the overall total consideration is £880,000. Also, we've got to be careful about is these shares here also are shares to be issued, which means that on my pro forma SSP, a line in my equity section for my shares to be issued, I've got those 280,000 shares in there, and if you can reference perhaps working 3. So that one's not the end of the world if you don't. You could have issued the 200,000 shares at £1.40 in this part of the calculation if you prefer. Okay. Then back to my information there. Have a look with everything in number 1. Well, I've already done my retained earnings at acquisition. I've now done my consideration. Let's see what else the question's got to tell me. So accounting entries have been made for the shares not yet issued. Well, I've just done that, so that now is done. It's telling me the values of the assets, liabilities, and contingent liabilities are equal to the carrying amount. Okay, that's telling me that there are no fair value uplifts. Okay, so nothing to worry about on that one there. Let's also see what we can find out about Basel. And you might decide in the exam, you know what, I'm going to leave everything to do with the associate until the end. I'll get Basel done out of the way, because I think that the associate is reasonably straightforward. So So, acquired 160,000 shares in Basel for £250,000 cash. Well, I've already seen that number, hadn't I? Consolidated in the individual SSP for deal investment. So I actually already put that number into working 7. It's already dealt with. But I'm being told that Basel has made a profit since acquisition of £42,500. Great, because in my working 7, which is my investment in the associates, I want the share of the post-acquisition net assets of my associates. What you've got to be careful of here is, what do we mean by net assets? Remember that net assets equals equity, which is your share capital and retained earnings. For AR, share capital will stay the same, and the movement on your retained earnings equals profits. So here, that's that £42,500. My parent share then is 40% in Basel, so 40% of £42,500. Let's put one in. I make it 17,000. Excellent. What I'm being told in the question is that in respect to the fair value of the assets in Basel, there was one machine that had a fair value in excess of its carrying value. And what I would say to you on this is that this is a fair value uplift in the associates. We'll come back to this later. So I'm not going to do this now, but I'm going to come back to this later because I think that's a slightly harder mark. I want to try and get the easy marks first. So make a little note to yourself somehow on your paper. I'm going to do a big red messy blob there to try and remind myself to go back. Try and find some other easy additional information then. I've already looked at number 3 to find out the fact that I was using the non-controlling interest. But there is also some other quite interesting information in here. It tells us that all revaluation reserves are prior to formation of the deal group. And what they're giving me is information to go into working 2. So in my working 2, I said, well, I didn't know what the reval reserve was at acquisition, but it tells me that the reval reserve was prior to the acquisition, i.e. it has not changed one bit. So I can fill this in, and I have no need for a working 6. And it's a job because I didn't bother drawing it out, isn't it? Had I discovered that there was a change, I'd have quickly set myself up a working 6. But no need to here. So that's another bit ticked off. You like to tick them off as you go. We've done number 1, we've done number 3, a little bit outstanding on number 2 that I've highlighted. We'll see what else we can find. A really refined method of going through these. Basically, have a quick scan and see if you know what's been on. Equally, try and look for anything short and punchy. So I've just spotted, just caught my eye, the word impairment. And I know that impairments are really quite nice and straightforward, but I'm going to jump straight to the impairment next, number 7. So telling me at the 31st of March, an impairment loss in respect of goodwill in relation to the acquisition of Rosemary of £35,000 needs to be recognised. There's been no impairment in respect of Basel. So Rosemary is my subsidiary. Let's deal with the impairment. Go back 2 places, so always try and think through the dual effect with any adjustments. Number 1 is it's going to reduce my goodwill. So that £35,000 will reduce my goodwill in Rosemary, because of course it's an impairment to goodwill. But impairment is also a one-off expense. And anything that's an expense is going to have an adverse effect on my profits, and it's also going to reduce my retained earnings. So here I'm going to squeeze line for impairments, and I've not quite left much space here, but hopefully I'll have enough room. £35,000. And you can just say in Rosemary, perhaps in brackets. Okay, that was an easy mark, okay? So make sure you're spotting the easy marks first, because I can very quickly tick off numbers now. What else we've got then. So let's have a look at number 4 next. It looks at number 4 like we're making some sales between one group company and another. So immediately after the acquisition, Rosemary, which is our subsidiary, sold some office equipment to Dill. What's going through my head at the moment, I'm thinking this is going to be an inventory perp. I need to think about setting up a working. So I'm up to working 8. It's going to need some space this time. I look at the inventory perp, the result of Rosemary selling to Dill. Now, I tend to always draw this in a picture, so I've got Dill, my parent, and Rosemary, my subsidiary. And in this particular scenario, Rosemary is selling to Dill. Visit the question and find out a bit more then. The equipment had been purchased for £20,000 and was sold to Dill for £25,000. Oh, it's not an inventory perp, is it? I've made a mistake, look. It's office equipment, so I'm going to change this. It's not an inventory perp at all. It's a non-current asset perp because it's office equipment. And the reason I spotted that was because they started talking about useful lives. So frightened if you miss something the first time round to go back and change your mind, just cross it out and pop in what it actually is. It told me, didn't it, that the sales price was £25,000. It originally cost £20,000, which means that there's a profit element that needs to be removed here. Now, the trick with a non-current asset perp is make sure that you calculate the perp in the right way. So calculate a non-current asset perp, all you're going to do is compare two things. So calculate a non-current asset perp, you're simply getting to compare the carrying value of the asset after the transfer, going to compare that to the carrying value of the assets if the transfer never took place. Then, the carrying value after the transfer would have been based on a £25,000 price. Because if you were Dill, you'd have paid £25,000 for that asset. That would have been the asset's cost to you. I take away 1 year's worth of depreciation because the transfer took place at the very start of the year. Now, what we need to be careful about is what the remaining useful life was. And it tells us that the equipment was originally assessed of having a useful life of 5 years, and that estimate has never changed. Now, we need to think about how many years this has been used for. The equipment had been purchased in 2009. It is currently immediately after acquisition. Make sure you've got your dates in your mind. It was acquired, or Rosemary was acquired, on the 1st of April 2010. So it's had 1 year depreciation that has gone. Okay, so 1 year depreciation used, 4 years remaining. So if you were Dill, you would say, well, I need to depreciate 1 year's worth of depreciation on remaining useful life of 4 years. So, sorry, £25,000 over 4 years. Get you to your thing value after the transfer, 18,750. If answer had actually never taken place, well, if you were Rosemary and you'd kept the asset, you'd have said, well, the asset originally cost £1,000 and I was depreciating it over a 5-year useful life. However, I'd owned it for 2 years. Okay, Dill only owned it for 1 year, but it only had 4 years left, whereas Rosemary would have owned it for 2 years already, and it would have had the original 5-year useful life. So it gives me 12,000. The difference between these two then is my non-current asset perp hits £6,150. Now, if you think about, now that we've calculated it, and you'll have picked up a good 2 marks for calculating that, is well, what do I now do with it? So go back to your picture and think, well, what's gone wrong? Rosemary, we need to adjust their profits. They've made a sale. We need to reduce their profits. We're reducing their profits. We're also reducing their retained earnings. Because subsidiary, if we're talking about their retained earnings, of that adjustment in working too. Still, I need to reduce their PP&E, which I'm going to do directly on the face of the consolidated FSP. So let's start with that because that's an easy one. I've got my pro forma here. All I simply need to do, I need to make some more space for starters, is get rid of my 6750, and I'm going to reference that through. I think I made it working 8. So then in working 2, my adjustments. So my adjustment here is my non-current asset perp, 1,750. That only exists at the reporting date. The perp didn't have that acquisition because obviously the sale happened the day after. So the perp only existed at the year end. And don't forget, once again, I'm going to reference that through. That's my working 8 number for you. I'll carry on with another piece of additional information. So let's see where we've got up to now. That's another one we can tick off. One ended up being a little bit trickier than we expected, but we still get to tick it off. Next then, I'll go to number 5. So during the current year, Rosemary sold some goods which had cost it £30,000 to deal at a markup of 50%. And I'm going to be super careful this time. Look, they've sold goods with inventory, which does mean this one is a more standard inventory perp. But these goods were in Dill's inventory at the year end, but the invoices have not been settled. It tells me that I need to cancel out my intragroup current accounts. So I need to cancel out payables and the receivables. And no, I'm going to need to set myself up a working. So I'm personally up to working 9, I think now. And 9 is my inventory perp. Again, I'm going to draw this out. I've got Dill, my parent, and Rosemary, my subsidiary. And this time, Rose sells to Dill and sell goods, let me get it right, that cost £30,000 or £30,000, sorry. So they used a markup of 25%, which means that my costs represent 100%, my sales will be 125%, and the profit element will be 25%. So I want to get to my sales figure from here. I just need to times by 1.25 to give me my sales price of 45,000. And from that, of course, I can work out that the profit element, not 150,000, I've got my comma in the wrong place, just 15,000. Then, was all of this in stock at the year end? Oh, why I've done a markup of 25%, guys. If you were online, I'm in a better place because it was actually a markup of 50%. The good news is I somehow got the number right, but I've written the wrong number down. So sorry, this should have been 150%, and my profit at the bottom should have been 50%. Oh dear, never mind. Then, things that I need to do with this. Firstly, I think about the balance outstanding, because as it happens, we have not settled those invoices, so I need to cancel off the payables and the receivables balance. And I'm going to do that is directly on the face of the financial statements by thinking about my trade payables and receivables receivables. Let's go to my pro forma. Here, trade and other receivables. I'm going to cancel off the £45,000 there, and also down trade and other payables, I'm going to cancel off my £45,000 there. That's an easy half mark that always gets forgotten, so don't forget to cancel off your intragroup balances. Let's now think about the more exciting bit. Let's think about the PERP. Well, your PERP is normally calculated as the profit element times the amount of stock left in at year end. But here, all of that stock's left in at year end. So what I really need to think about is whose adjustment do I need to make where. So once again, let's come back to my picture. Rosemary, their profits are too high, which means that their retained earnings are too high as well. If Rosemary is my subsidiary, I'll adjust everything to do with their retained earnings in working two. Deal inventory is too high, so I'll make that adjustment in the consolidated SSP. So my adjustments for the £15,000. Let's go into my SSP pro forma. Here we go, my inventories. I'm going to adjust the PERP 15,000 and reference this working 9 as well as the 45,000 down here. Also in working 2, to scroll back up to the top of the page, I've got my inventory PERP work 9. That was £15,000. Away with zeros tonight, and adjustment to retained earnings. All your adjustments in working 2 are always to retained earnings. That means that we can tick off one more adjustment. Actually, we've still got some time left, but if not, we'd close off working 2 and move on. But we've got one adjustment to look at before we go back to thinking about Basel. So next, on 1st of April 2010, Dill entered into a 4-year operating lease with an unrelated company with a payment holiday for this current year. 3 payments of £5,000 are due next year, the year after, and the year after that. Dill has made no accounting records in respect to this lease, nor Dill. So, things this points out to me, this is actually something that Dill has done wrong in its individual financial statements. And the problem with that is that those individual financial statements that are incorrect are going to flow through into my group accounts. To first correct the individual financial statements to get my group accounts right. Now here, I'm just going to simply correct the group accounts because that's what the requirement is asking me to do. So let's set up a working for this operating lease. I am up to working 10. This is operating lease. What I need to think about is, well, what's the right treatment of this lease? The right treatment of this lease is to say, I need to recognise operating lease rental expense. I need to recognise it on a straight line basis. So I'm going to take the sum of all the payments, 3 payments of £5,000 each, and spread them on a straight line basis over the 4-year lease term. That gives me an expense of £3,750,000 in Dill's financial statements. So what I need to do is reduce Dill's profit and therefore its retained earnings by the 3750. And when I'm going to do that, of course it's going to be working 5 if I'm talking about Dill's retained earnings. And let's show you that. What we're saying is a number that we've put in here for Dill's retained earnings, it's not actually incorporated that operating lease. So what I'm going to do is I'm just going to put underneath my operating lease adjustments and reduce here by 3750. Now, you could have done that down at the bottom, but I just wanted to link it together so that you can see it's a problem with the parent Dill's retained earnings. Okay, that's all there is to that one. So that one was actually very nice and straightforward. After all, I can tick it off. Gives me just one more thing to think about then. I've left this to the end, my fair value uplift on my associate Basel. let's have a think about it. So, the assets of Basel were equal to their carrying amounts with the exception of the machine, which had a fair value of £15,000 in excess of its carrying amount. The assets have a remaining useful life of 5 years on the 1st of October 2010. No adjustment has been made in the books of Basel. And it's given me the 1st of October as a date. If I just remind you from number 2, number 2, is that was the date that we acquired Basel. Okay, it's just the date of the acquisition. Now, what you've got to be careful about is that a fair value uplift, if it were a subsidiary, I would uplift the PE number on the face of the SST. But we consolidate associates, so I'm not going to do that here. In fact, everything I do with the associate has got to be in working 7. But I've incorporated here the cost of the assets, and what I paid for my investment in Basel, I would have factored in the price of that machine. So you do not need to include the fair value uplift. What you do need to include, and this is really tough, this is what I would call a prize winner point, so I'm going to get my prize winner cup out here. The prize winner point is to know that you've got to bring in the share of any fair value depreciation. So 40% of the depreciation on that fair value uplift of £15,000 of 5 years. Okay, the £15,000 you don't need to include because you assume you factored that in when you bought the asset, but you need to depreciate it. Now, what makes this even more pernickety is that I need to prorate for 6 months because I bought Basel in October and my year end is March. So don't forget to prorate. That's where having your year end handy is very, very useful, so you don't forget things like that. That gives me a fair value depreciation of £600. And out with all of the additional information. So do you know what? While I'm here, I'm going to add up all of the investment in the associate, 266,400. Now that I'm done with Basel, I'm going to go and pop that into my pro forma, 266,400. Reference is all there as well. I'm through all of the additional information, haven't I? So the only thing left to do is go back to working 2 and finish everything off. So I need to make some totals, don't I? I need to add up my assets, my equity of the subsidiary at the reporting. That adds up to 985,150. At the acquisition date, 867,600. And I also need to calculate my post-acquisition change. Please do use a curly bracket to show the examiner exactly which numbers you're adding up. So I'm doing the 356,900 less 6750 less 180 less the 217,600 to get my movement of 170,550. And of course, if you want, you can show the examiner. These are going to workings 4, workings 3, and workings 5. When you've got these numbers enable you to go on and get lots of other very nice easy marks. So here we go, down to my working C. What was 100% of Rosemary's net assets at acquisition? I'm going to reference it to working 2, but we've just seen that from the middle column, it was 867,600. When on my NCI, because we're using the proportionate method, it's just 40% of that very same number. It's only 20%, sorry, we own 80%, so the NCI share is 20%, so that gives me 173,520. Don't forget this is minus 100% of the net asset, so I'll pop that in my brackets. Again, it's just a case of filling in. I've already got my impairment in there ready to go, which gets me to my goal of 150,920. And as soon as you calculate a number, back to your pro forma, 150,920, and fill it in. Okay, so please fill in your pro forma as you go along. Before, I've got MCI share is 20%, times by the net assets at the reporting date, so the first column of working two was 985,150, which gives me 197,030. And I'm going to go straight to my pro forma, my NCI line, and fill that number in, 197,030. On to week 5, I can now fill in my parent share of the post-acquisition retained earnings. These are from the final column, the movement column of working two. So for Rosemary, 20%, no, it's 80%, talking about parent share. So 80% of my final column was 117,550. I've got that number calculated, that's 94,040. Now Basil, I want the parent share of the associate post-acquisition retained earnings, and you know what, we've already calculated that. That's this 17,000 here, and I also want this 600. So I'm just going to copy those 17,000 and the 600. I'm going to do it on the one line because they're numbers I've already calculated. If you wanted to, you could split those out. So that gives me my 16,400. And if you want, just reference those to working 7. I have everything there then. So once again, it's just a case of adding up 839,190. Always pop it straight into here, 839,190. And I've finished everything to do with my standard workings. The only job I've got left to do is to close my bracket, so for PP&E, and add across the numbers. So PP&E, I get to 1,411,450. So my inventories, make sure right line, 506,500. Receivables 340,300. Cash, that was very boring. No adjustments there to cash, just 2,200. Reval reserve, so I'm not going to bring that in. I'm just going to put a dash there to say I didn't need that. And get to my, oh, I'll tell a lie. Whose reval reserve do I need? I need the parents. So I'm just going to bring Dills in, because everything in Rosemary was pre-acquisition. But if you have a quick look back to the question, and perhaps we could have spotted this much earlier on, if you have a quick look back, here Dill's got a £250,000 revaluation reserve. So let's at least pop that in. The reserve in Rosemary, remember, it was all prior to acquisition, so I don't need to bring it in. Adding up payables then, 381,550. That's my tax, 200,000. The other thing that I'm sorry I've missed off here, in my trade and other payables, I need to have an accrual for the operating lease rental. So let me just very quickly go back to the working because I've missed one out. In operating lease rental, as well as having to reduce my retained earnings, I also need an accrual. 3750, sorry, should also be here. Working 10. I've put it up in this total here, sorry. Just realised I've missed that one out. It's just a case of doing your totals. What I suggest you do in the exam is up your asset section, and whatever number you get in the total asset section, pop down here as well. The chances of your balance sheet balancing, well, it would be nice. However, the chances are you might run out of time and you may not have processed all of your adjustments. Okay. If I go back to what our plan of action was for the day, we said we were going to do a big question from start to end. We aren't done with our big question from start to end. So what I suggest you do just now is pause the online tutorial and take a bit of a break. I'm indeed going to pause it quickly now and make myself a cup of tea, but then I'll resume the pausing for you to pick up with NCI and impairments and goodwill. And if we pick up, let's have a think about our non-controlling interests next. And in your workbook, if I get past still that we've already finished, we've got a question to illustrate the different methods of valuing your NCI. So remember, there is a choice between either using the fair value method or the proportionate or share of net assets method. Okay, proportionate and share of net assets method are the same thing. The value method can also be called the full goodwill method as well. Let's go down to our requirements at the bottom. Calculate the goodwill, NCI and retained earnings at the 31st of December 2008 using both the proportionate or the share of net assets method and the fair value method. If for your requirement and you were thinking goodwill, I want you to think automatically I need a working 3. NCI, automatically I need a working 4, and retained earnings, automatically I need a working 5. Now, spot that you need working 3, 4 and 5, it makes sense that you also need working 2. It makes sense to set yourself up a working 2 as well. So why don't we just set these up? Let's extend this page so that it's nice and clear again. I set myself up a working 2 for the net assets of S. And I have to think about this, of course, at the reporting date, the acquisition date, and then the movements between the two. And I'm looking out for things like the share capital. Maybe there's some share premium. It does just depend a little bit on the question. Definitely some retained earnings, maybe a reval reserve, and some adjustments. Now, fill in the rest of the workings as we go along, just because this is a more illustrative point of both of the methods. Let's just see what information that we've got about our company. So on the 1st of January, FOOT acquired 75,000 shares in Belt for £750,000. Issued share capital was £100,000. So if you want, you could almost do yourself a little working 1 to the side. We've got FOOT and Belt, and if FOOT acquired 75,000 of 100,000 shares, Ilya subsidiary, and we own 75%. On January 2008 then, the fair carrying amount of the net assets was £600,000. So it's telling me that the net assets at acquisition of Belt £600,000. So it's telling me actually these two balances combined. Let that in for now. I might change on that in a second. On the fair value of the equity shares not acquired by FOOT was estimated at £175,000. So that is telling me my fair value of NCI. That's only relevant if I'm using the fair value method at the SSP of both of the entities. So as we've got their non-current assets and their current assets, and then we've got their equity section. Well, this is quite nice, isn't it? Because these two numbers here go into working 2, which is what I'm just working on now. So let's pop that £100,000 and £880,000 in as my assets at the reporting date. So what did we say? 100,000 and 180,000. What I'm just going to quickly do then is improve on this 600,000. If I know that the net assets are £600,000, for FAR, share capital will always stay the same, which means that I can deduce the retained earnings at acquisition must have been 500,000. So I'm just going to get those bits and leave that in instead. Okay. Now, in this particular question, there are absolutely no adjustments. It's not the purpose of this question. So I can instantly work out my movement on retained earnings. It's 380,000. I work out my total net assets at the acquisition and at the reporting date, 980,000. and we were already told 600,000. Okay. Now we can get into the nitty-gritty. Let's start by thinking about our goodwill. So one of the things that we've been asked to calculate is our goodwill, and we've been asked to calculate this using both the value and the net assets method. Now, I am just illustrating this to you is to do these side by side. So if I do the net assets on the left-hand side and fair value method on the right, my formula or my set out, if you like, is still going to be the same. I need to take my consideration and my non-controlling interest to 100% of the net assets at acquisition. There's no investments here, so there'll be no impairments to get to my goodwill. Okay? What do we know? We, from the very first sentence, that Foots acquired 75,000 shares in Belt for £750,000. Now, that will be the same, regardless of which method we use, so I'm just going to pop that under both columns. Also know from my working to that 100% of the net assets at acquisition was £100,000. So this one here came from working to £6,000, and that won't change either, regardless of whether I use the fair value method or the share of net assets method. What will change then is my NCI, because it is a choice of accounting treatment. In the share of net assets method, all I do is take my NCI share, which here is 25%, 100% of my net assets, which is £600,000. Here, simply 150,000. If I use the fair value method, I simply take my NCI at fair value, which always has to be given to you in the question. Okay, so they won't ever ask you to calculate it. They will simply give you that number, 175,000. Of course, as a result of those two numbers there being different, the goodwill at the bottom will be different as well. Goodwill, how much is it going to work out to be? It's going to be £100,000 using the net assets method, and £325,000 use the fair value method. What's the reason for that? If you use the proportionate method, what you are given here is the parent share, here 75% of the goodwill. Where if you use the fair value method, you are given 100% of goodwill. From that, I can deduce that NCI goodwill, 25%, will equal £25,000. And what I want you to notice is that that £25,000 not only is the difference between the 325 and the 300, it's also the difference between the 175 and the 150. That's important later on. The only thing that's different, that one line for your NCI. Okay? That's our working three under both methods. Let's have a look at working four, our non-controlling interest. For this one, I'm not going to do these working side by side. I'm just going to do them separately. And I'm going to start by thinking about the share of net assets method. This is easier, and this is what we saw in the previous question deal, where you simply want to take the NCI share times the subsidiary's net assets at reporting date. NCI share here is 25%. What net assets of the subsidiary at the reporting date is £980,000. Which means that they will be depreciated and never subject to VAT at the lower rate of 5%. That was into my calculator, sorry. I do not have this one worked out. So 980,000 over 4 is £245,000. That was quick. The reason that works is when I'm looking at the net assets here, this is everything except goodwill. The goodwill was in working 3, and I've only used working 2 so far. But okay here, because if I've used the share of net assets method, I've only shown £300,000 worth of goodwill on the balance sheet, and all of it belongs to me. None of it belongs to my NCI, so I don't need to show their share. So we simply leave it at that for working 4 for our proportionate method. If, however, you're using the fair value method, it's a bit different. There are actually 2 different ways that you can approach this working, and it's just personal preference. You'll always be able to do both methods. So method 1, or let's say option 1 if you like, so I don't want to say it's a different method, it results in the same number. So approach 1. Well, to say let's start off exactly the same. Let's say, what's the NCI share of the net assets at the reporting date? We'll just work that out as above. £145,000. So it's just simply 25% times by the £980,000, 45 grand. The problem is then, that's everything except the goodwill. If I use the fair value method though, I need to think about the goodwill. If it's the fair value method, I've shown £325,000 for goodwill on my SST, which is 100% of the goodwill. If I'm 75% of the subsidiary, I need to show the NCI share on that. So I also need my NCI goodwill. Now, what I can't do is to take 25% and multiply your total goodwill. Because if you notice, the proportion here, 25% times 325 grand, doesn't equal that number. That's because of something called the control premium. You would pay more for a controlling stake than you would for a non-controlling stake. So the way that we calculate your NCI goodwill is take the difference between the fair value of your NCI at acquisition here, NCI share of the net assets at acquisition. So it's going to be the £25,000, but I'm going to use this line to calculate it. That's just to save you time in the exam, because in the exam there's no need to calculate goodwill under both methods. The only difference will be this one line. I'll put that down underneath. Difference between your fair value of NCI, which here was 175,000, and NCI share of net assets at acquisition, 25% times by 25% times £600,000. That's the number I'm looking for. So 25% times 600k. So 150 grand. So I need to find a number there. I need my NCI goodwill of 25,000. Getting carried away with my zeros tonight. I really am. So just £25,000 there, and I total it up. I've got total NCI on the year-end balance sheet of £270,000. Okay. So method 1. Method 2, or approach 2. I'm going to roll forward my NCI. So I know what the value of NCI was at acquisition. What I'm going to do is try and see how much I need to increase that NCI by. And all you do is essentially treat this a bit like retained earnings for your NCI. So you simply add on the NCI share of the subsidiary's post-acquisition net assets. I've got that number in working 2. It's the number that normally goes into working 5, so £380,000. So that's on 5%, £380,000, which is 95,000, and I get the same 270. So it doesn't matter which method you use, you'll get to £270,000 in both instances. So looking for under both methods, that finally leaves us then working 5. Working 5 is our retained earnings. This working, thankfully, is the same under both methods. It doesn't actually matter which method you use. Working 5 is identical. All we need to do is take 100% of the parent's retained earnings at the year end. That was £1.5 million from the balance sheet. And to add on the parent share of the subsidiaries post-acquisition assets, 5% of that 380 grand from working 2, and that 285,000. Now, then a real example question be more adjustments. Here there aren't, so simply 1785,000. Okay. To take away from this, when you use the fair value method, you end up with 100% of the goodwill. When you use the proportionate method, you just end up with the parent's share. So come back to our list plan for this evening. We now looked at the different choice of treatment between using the fair value method and the proportionate method of measuring your NCI, which means that we've got one last thing to look at, which is impairments and their impact on goodwill. And again, we're going to see the difference depending on whether we're using the fair value or the proportionate share of net assets method. So once again, right in the last page of your online tutorial workbook, here we go. We've got an example of fair value of NCI, NCI at fair value and impairments. Now, we're not going to look at proportionate because that's very straightforward, but we are going to see what's happened if we're using the fair value method. So requirements, calculate the goodwill, NCI and retained earnings on 31st of December 2007. The 1st of January 2005, Foot acquired 60% of the equity shares in Belding for £900,000. To measure NCI using the fair value. At that date, the fair value of the carrying amount, the fair value and the carrying amount of Belding's net assets was £850,000. And on the same day, the fair value of the equity shares not acquired, so that's my fair value of NCI, was £430,000. If you like to annotate these up, this is my consideration, isn't it? This is my net assets at acquisition. This one here is a fair value of NCI at acquisition. At year end, I have an impairment of £280,000 to be recognised. Finally, it's telling us the value and the carrying amount of the assets recognised by Belding at the year end date is £1.1 million. That's my asset at year end. Retained earnings then of Foot at the year end are £1.2 million. So that's my retained earnings of parent. In this question, once again, we're asked for goodwill, working 3, NCI working 4, retained earnings working 5. So hopefully you'll spot the trick to it. I'm also going to do a working 2. Working 2, I'm just going to have my net assets at the reporting date, the acquisition date, the movement, and what I find in this particular question, this is very, very straightforward. So it's just a case of spotting the numbers. I'm looking for the net assets, there we go, at acquisition. I'm looking for the net assets at the reporting date, and then I can work out the movement between them. So I've got 850,000 and 1.1 million. 850,000 and 1.1 million. So this is just my total net assets. We're not splitting them out here between net capital and retained earnings. So the movement of £250,000, and these numbers will go into working 5, working 3 and working 4. Excellent. Then let's have a think about my goodwill workings. So working 3 for my goodwill, I'm using the fair value method this time. The fair value method, I'm going to start with my consideration. I'm going to add on my NCI, this time at its fair value. I'm going to take away 100% of net assets at the acquisition date, and I'm also going to take away any impairment. So let's again just try and spot these numbers. My consideration, there it is, £900,000. Value of NCI at acquisition, £430,000, and I can get the number from working 2. So £900,000 consideration. Add on my fair value of NCI at acquisition. If I can find that number again, what did I say it was? 130,000, sorry. Given in the question, and then I can take away 100% of net assets at the acquisition date. So here we go, that's just my standard £850,000. Also told then in the question that we had impairment in the year of £280,000. So I can calculate my total goodwill at the year end of reporting date is going to equal £200,000. Now, so I need you to spot. If using the fair value method, this is 100% of goodwill, and if this is 100% of goodwill, this must be 100% of the impairment. Otherwise, this calculation wouldn't be like for like. It just simply wouldn't make sense. So £280,000 is all of the impairments. Okay, fine for working 3. But let's see the impact on working 4. So working 4 is my non-controlling interest. Now remember there are 2 ways of doing it. So let's again break it down. I've got approach 1 and then I've got approach 2. Let's make it we're using the fair value method here. Approach 1, what I'm going to start with, I'm going to say, well, what is the NCI share of net assets of the subsidiary at reporting date? What is the NCI share of the goodwill? NCI share of the net assets at the reporting date, that's simply my NCI percentage, and I believe we're 60% built, so the NCI share is 40%. The assets at the reporting date, well, I've quite nicely got a working 2, haven't I? That's £1.1 million, which gives me, I think, £430,000. £440,000, sorry. Calculate my non-controlling interest goodwill. I have the difference between the fair value of NCI at acquisition and the NCI share of assets at acquisition. And again, the numbers that we know, don't we? The fair value of NCI at acquisition was £430,000. The NCI share of net assets at acquisition, well, it's going to be 40% of the net assets at acquisition were £850,000 from working 2. I'm going to put that one into my calculator, sorry, so 0.4 times by 850,000, 140. So my NCI goodwill is going to be £110,000. Did I assets acquisition? Yes, I did. That's perfect. 40 less 340. What I can't do is maths. So I was thinking that number didn't quite look right. Sorry, that's £90,000. What I now need to think about is the impairment. So impairment that I recognised was 100%, so I also need to take away the NCI share of the impairment. Let's go back. The impairment here, 100%, and I need to split out so that 40% belongs to my NCI in week 4, and 60% of it belongs to my parents in retained earnings, working 5. So I'm going to take away 40% of £280,000 impairment, £112,000. That gets me to a total NCI of 418,000. Okay. Start normal, your NCI share of the net assets at the reporting date, and NCI goodwill as normal, but because I'm then showing the 100% of goodwill, I also need to give the NCI its share of the impairment. Alternatively then, you do my second approach, which was the roll forward method. You say, well, hang on a second, I know what the fair value of NCI was at acquisition. It's £430,000. I'm going to increase that by the NCI share of the subsidiaries post-acquisition net assets. Got in working 2, it's going to be 40% times by my movement column, 250,000, and that works out as £100,000. Once again, I need to give the NCI its share of the impairment. This is actually the same number as before, £112,000, simply your 40% of the 280,000 impairments. Once again, you calculate your total NCI to be £418,000. Whichever your preferred method is, you will always come out with the same number for your non-controlling interest. So to finish off, we've got working 5, which is our group return earnings. Some nice easy marks here, aren't there? We want to start with 100% of the parent, so 100% of FTSE retained earnings. It tells us that in the question it's £1.2 million. I want to add on the parent share of the subsidiaries post-acquisition net assets, acquisition retained earnings. Well, that simply here is going to be 60%. Again, from working 2, it's that same £250,000. That's 150 grand. Get rid of these dots. But now I also need to think about the impairments. But what we've got to be careful about here is that I only want the parent share. It's a £280,000 adjustment now. I'm going to be double counting because if you look, I've already done £112,000 of the impairment in working for NCI. So it's simply 60% of the impairment, which is £280,000. Really make this one clear because that one was 250,000. 60% of my impairment then is £160,000, and if you want, what you can see is that 160 plus 112 equals 280, and I get to my overall retained earnings of £1.182 million. Be careful then, if you're using the fair value method, you need to split out the impairments. If this were the proportionate method, you would just put all of the impairment in here and none of it into your working 4. The reason being is if you're using the proportionate method, this would just be the parent share of the goodwill down here, which would mean it's just the parent share of the impairment. So all of it goes to working 5.